This is the second week in a row I've done this to Octavio, and I feel terrible. And Dan, you'll be up after Octavio. So Octavio asked a question. It was one of the first ones, but the way the conversation went, we were staying with this credit spreads, and we talked about the rolling, the covered calls, and the portfolio tools, and we touched on calendars briefly, but we never really got into it, and unfortunately I was just trying to answer the questions. Octavio's been sitting here waiting with a simple question. Michael, what's your opinion on using calendar, put, or call spreads? Okay, I actually had a conversation with Ernie about this today. Anyone out there who is a subscriber or a trial member, I'll likely tell you right now, if you schedule one of the coaching sessions, which you should feel free to do at any time, you can leave a note saying what you want to discuss. And if you say, I want to discuss calendar call and calendar put spreads, unless I have a webinar on that time, if Ernie gets that coaching session, he's going to call me up right away, and he's going to say, hey, this guy scheduled a coaching session for 11 a.m. on Tuesday. Can you take it? Why, Ernie? Does he want to talk about calendar spreads? Yes, he wants to talk about calendar spreads. So he'll send you over to me. In any case, I am a fan of diagonal call spreads. I do, and diagonal put spreads if the market conditions are correct. I love these things. I did these things for years and years. I did diagonal call spreads for years and years. And then I sort of moved into the married put trading and collar trading, and then I really started to get in these bull puts about 4 or 5 years ago is when it started. It was like 2016, end of 2015. So I put my efforts into the research, analysis, and trading the bull puts. I had mentioned a minute ago, Octavio, that you should never do you should never do the credit spreads. The allocation for credit spreads in your portfolio shouldn't be more than 15 or 20%. 20% I'd say is the max. I usually use around 15% of my total portfolio to allocate to bull put spreads because it's the lie of leverage. So what do I've got? I've got 50% of my portfolio roughly in the married put trades, Octavio. I've got 15% off and on in bull put credit spreads depending on the market conditions. 10 to 15% in calendar calls or calendar puts. Diagonal spreads, okay? Maybe 5% or so playing around with earnings straddles and so forth along those lines. And then 1 to 2% I use for that market hedge, puts on SPY, VIX calls, maybe contra ETFs as Sam does, or UVXY, shares of UVXY, for example, if the VIX options are too expensive, okay? I really like these. I do. It's something that's so strange to me, though. And what do I mean by that? All right, so let me make sure I'm in the right group here. Nope, I'm not. I want to go to this search, and I'll explain why in a minute. So Ernie called me today. He was developing a calendar call on Viva Systems, and he said, okay, so honestly, Mike, what am I missing? Am I doing anything wrong here? Because, hey, he knows what calendar spreads are. He knows I trade them a little bit more frequently than he does. That's not bad. He knows exactly what he's expecting for Vive, and so that's how he structured the trade. But I noticed a couple of things with it that stuck out to me for me personally right away. And it's not here. Why don't we just do it? Why don't we just do it? We'll look it up. No, we'll do it this way. Okay, sorry. Yeah, okay, so let's just take waste management, for example. Stocks at 103.89. We could sell an out-of-the-money 115 and buy the April 95. This might even be too far out in time for me. We're going to shorten that time period. What do you say? But let's just go to the profit and loss chart. I know why it's like that. Okay, there's a reason why it's like that, actually, and that's because the increase in volatility. Okay. The structure I would actually probably use on this position, if I got, the 95 looks good. It might go a little bit lower. It doesn't offer weeklies. That's why. But we'll stick with June for now. And 3 to 9, that's why the premium's bad. So let me go back to July. Yeah, more room, good $2 there. It's not too bad. So I'd probably do that structure here. It's going to look a little bit better for me. But that being said, it's probably the wrong structure, and we'll see why in a minute. Oh, I'm sorry, folks. All right. Okay. Let's call it 190. All right, sorry. Great. Okay, so my debit is 1335. Oh, thank you. Okay, great, perfect. It works. Ernie's position that he structured for his expectations, Octavio, he had a debit, I think, of $31 and something, and he was using, it wasn't this stock, but he was using a 20-point strike difference. is a 200 to 220 with a 31 debit. Right away, that stuck out at me because it's dangerous. And we've had a lot of webinars on this recently. I'm going to show you where those are as well, Octavio. Okay, so this is the structure I look for, and I enjoy it. What's the advantage? Hey, instead of paying $103 per share, I'm only paying $13.35 to simulate a covered call position. But the one thing I will say is that there's a term out there that's called the poor man's covered call. It's a sales term for diagonal spreads. I don't like that because I think it's extraordinarily dangerous and misleading. Okay? This is not like a covered call. Why do I say that? It looks like it, and I'm taking advantage of a covered call with a lower cost basis and really good high percentage return. You have to remember that leverage works both ways. But also, when you're in a covered call, what do you know? That if the stock moves up, well, you get assigned at any of these prices and you got a flat. You make your 3% return. The stock could go to 200. It could go to 103.10. It could go to 400. You're going to make 3%. Not talking about rolling. That's just the expectation of the trade in the position. Now, on the diagonal spread, you have this maximum return of 51.3%, which occurs only here. Only if the stock is trading right at the short-term strike price at expiration. Why am I going through this? Because this is where a lot of investors get confused and get into trouble with this strategy. First off, that rarely happens. But if you're good at pinning again and picking the stock price, this is your target. This is also based on something else, isn't it? This is based on the theoretical price of this 95 October call if the stock is trading right at 110 next week on June expiration. It could be lower. It could be higher if volatility increases. We're using the best estimate we can. Okay, so what you have to take into account is this is not etched in stone because the value of the long option can fluctuate based on market conditions, volatility, and what's an expected return based on the expected price of the long at short-term expiration. I'm still a fan of these though. Why was it so important to me? And then, you've got other criteria that you'd look for, such as delta ratio and implied volatility ratio. I'm going to show you where the discussions are on those. But did it bother me? Why was I worried about Ernie with his position when he had a higher cost basis than his difference in strike prices? Okay, why is that a concern? Number one is because in those strategies, you typically see this. You start to go back. So now you have an upper and a lower break even. This one's not as bad, okay? But if that debit is too high, you get into a zone here where you can have two losses. I'm talking about diagonals too, Octavio. Diagonal means I'm selling a premium that's above the stock price and I'm buying a few months out in time in the money, lower strike for a debit. What do I never do personally is what's called the horizontal spreads. A lot of people say that a calendar spread is the horizontal. Well, I say calendar spread is any combination. My definition, our definition here at Power Options, calendar spread is any combination of buying one option, selling another on the same stock with different expiration dates. So the horizontal is a calendar spread, but they're at the same strike. I'd be selling the 105 for next week and buying the October 105. It's your 10th profit and loss chart, sort of like a butterfly or a short straddle, a diagonal or a short straddle position kind of here. And it's a peak here, profit and loss chart, which is very difficult because you quickly have to manage it as it moves up or down because you're closer to the money, which means you get more premium up front. But to manage it, to not go into the loss on the upside or the loss on the downside, you have to be very, very fast. Okay, you have to watch it consistently. That's why I don't like horizontals. But this is why I never enter any diagonal, the calendar call diagonal, calendar put diagonal, where the net debit is greater than the difference in the strike prices. The other main risk factor here is, let's say my debit was 18.10, okay? And I've got a 15-point strike difference, don't I? I bought the 95 and sold the 110, so we're at a 15-point difference. Something comes out Monday, waste management gaps up to 120 out of nowhere, okay? Now, I'm saying here that I should still be at a profit. It's okay, but I'm going to look to manage it, but suddenly I'm assigned early. The person who bought the 110 call, or the investors who bought the 110 call, sell to close them for the profit, and the market maker has to balance it out. So he starts assigning these. Well, I don't own the stock, so what ends up happening, Octavio? My broker is going to exercise my long at 95 to deliver the short at 110. I only get $15 back. I'm at a loss of 310. Not a small gain. I'm down here. Okay? I'm in the loss zone. Because of this risk, this is why you never want to do a diagonal spread where the debit is less than the difference in the strike prices. I'm sorry, where the debit's greater than the difference in strike prices. You always want the debit to be less than the difference in strike prices. And you want also, in addition to that, is to give you that better looking graph where you don't necessarily see an upper and lower break even. So I'm a fan of these. But it's not as simple as saying, hey, I traded covered calls and I was doing really good. I want to save some money, so let me start looking at calendar spreads. You don't own the stock. You own a second option with a working delta, a working gamma, and a working theta, and you sold a near-term option with a working delta, a working theta, and a working gamma. You've got implied volatility fluctuations where the short might be more affected than the long. That can throw your position off balance a little bit. That can say, wait, I should be at a 40% gain, but right now with 2 days to expiration, I'm only at $200. What's wrong? Well, if the short option implied volatility increased, your buyback cost now looks higher, even though you're hoping it's going to expire, but your buyback cost is now much higher. Okay? But I'm not trying to scare you, Octavio. These are fantastic strategies. I enjoy them immensely. And I think they're good strategies to do, but you just remember, it's not just jumping ship from a covered call position. And I personally am not a fan of the horizontal, the same strike calendar spreads. I prefer the diagonals, buying an in-the-money call and selling it at or out of the money call, buying an in-the-money put and selling an out of the money, at or out of the money put near term against it as well. Okay, you probably heard me clicking there. Should be paused. I'm just going to a different website here real quick. Now I'm going to have this, I'm going to have the programmers, I was meant to do it today, but I got called off on a couple of other projects. I know, you're not seeing my screen. I'm sorry. I'm doing this for a reason. Okay. So what I did is I'm logged in, of course, to my position here. There we go. I'm logged into YouTube. But if you go to the YouTube channel, you can just go to YouTube and search for Power Options, Octavio, and then do a search on the Power Options channel for calendar calls. You'll see these first four here, which I think are very, very recent and very useful, all from May and March. So the one recently was a very similar question. Calendar spread, poor man's covered call. Let me get rid of this window. There you go. Okay, so you got the first one there, calendar spread, poor man's covered call. We answered Jim's questions related to the criteria. That was from May 28th, a couple weeks ago. On May 8th, we spent 29 minutes answering a question about management techniques. And then this one here, 28 minutes from March 3rd, what are the disadvantages of a calendar call spread? I talked about some of them, but there's one other one that I need to touch upon. Okay? One other main one here as well. So you can do that. Just look for calendar call when you go to the Power Options YouTube channel, Octavio. You've got 3 great webinars there on calendar spreads that are very recent and more in depth of the discussion of the criteria, management, and the risks. In addition to what I just showed you about that specific criteria, the debit to strike difference ratio, very last concept that's important. And this is why I don't like using the term poor. The second reason why I don't like people using the term poor man's covered call. Number one is because if it goes up, you don't flatten and stay at a specific return. You can actually be at a loss if you structured it incorrectly. Number two, leverage works both ways. It is very important. And I'm not trying to talk down to you, Octavio. I know that we've had plenty of strategy discussions, but many investors tend to miss this when they start looking at this structure. And what's that? If I bought the stock at 103.89 and I sold the 110 call even for that, what was that, $3 in premium or $1.90, okay? But let's say I sold the 105 and I generate 3% premium. If the stock falls 10%, $10.40, so we'd be trading around 93.49. What would I lose on my covered call? Well, I'd lose 7% of what I invested. The stock dropped 10%, but I kept that 3% premium. I'm down 7%. All right, rock on. However, leverage works both ways. And if the stock fell to 93.49 to our, oh, this was the, sorry, I used the July one here. It wasn't next week, it's July. So let's go out. If it falls, let's say in the first couple of weeks, we have another unfortunate Thursday like we just saw, and we lose 10% in the stock. Remember, our debit is 14.35. I changed the numbers a little bit. It's 14.35. So that long option we paid $16.25 for would drop $9.93. We've lost $632 of it, which is not half, but it's close, isn't it? It's about 40%. You've lost 40% on your investment. Yes, you keep the 181, but that was already taken into account in the debit. So the stock falls 10%. The value of the long call is $9.93. Okay, so $500 out. So we're down 33, 35%. That's what you have to keep in mind, is that this is not like owning the stock. Okay, it's got a different delta. It's going to be leveraged. You got into it for the leverage, but remember, you can see 30, 35, 40% declines on these positions when you have a 5 or 10%, 15% decrease in the stock, like we had yesterday. That's another reason why I'm only doing this with 10 or 15% of my portfolio, whether it's a calendar put spread or a calendar call spread, Octavio, because that can and does happen like we saw yesterday. I wasn't in the calendar spreads yesterday, I'll be honest with you. I was in the bull puts and got lucky that they didn't get crushed. But again, and that's what we're talking about. So I think there are good strategies. They're very useful strategies to use. I think they should be a part of your portfolio, but you got to master them as well, okay? All right. All right, and Octavia, you said you were told to stay away from the poor man's covered call. Yeah, that's the term that's used for the diagonal spreads. I just don't like that term because I really hope it's a sales term, right? So it's poor man's covered call. Hey, why do I have to pay so much for the stock and then sell the call? Why don't I just use the leverage? Okay, that's great, and I understand why you're using that term to sell it, but it's not a covered call. It's not just jumping, hey, let's just do a covered call but do it more cheaply. There's a lot more moving legs involved in that, and it can get people into trouble by assuming the wrong structure where they can actually lose in both directions. And we saw some of the other ones as well. I think they're useful strategies. I think you can set them up constructively and safely. I've had decent success with them, not as good as bull put credit spreads, but I've had decent success with the calendar calls and calendar puts over time.